I talk to people all across the country all the time that, whenever they hear that the Fed just lowered the discount rate, my phones begin to ring off the hook. And they say, well, the Fed just lowered the discount rate. And I'm quite sure since the Fed lowered the discount rate, the home mortgage rates are going to go down, and I am going to want to refinance when that happens. Well, let me share something with you. Just because the Fed lowers the discount rate, that doesn't necessarily mean that the mortgage rates are going to go down. Usually when the Fed lowers the discount rates, sometimes the bank will lower their prime rate, and the prime rate is the rate that banks give to their most credit-worthy commercial clients. So it doesn't necessarily mean that mortgage rates are going to go down. But if you want to know the truth of the matter, the thing that affects mortgage interest rates the most is the market. The market, yeah. Not the Fed necessarily. Now, when they buy bonds and things like that, yes, and it could have an effect on the rate, but not for the most part. So people often say, well, I want to refi. Just because the rates go down a little bit doesn't necessarily mean it's the right time for you to refinance your home. There are certain factors that you may want to consider. And here are some of my rules that I like to go by. Number one, when you're thinking about refinancing your home, first of all, make sure that you plan on staying in the home for a while. Now, if you only think that you're going to be in the home for less than a year or maybe 2 years, and you know that you're going to move out of that home and you're going to sell that home and you're going to leave and go somewhere else, if you're not saving a substantial amount by refinancing or reducing your interest rate to a level to where it's really a huge benefit, sometimes it's not the right thing for you to do. It's not really good for you to refi if you know you're going to be moving, especially if you know you're going to be moving within the first year. So I wouldn't encourage you to refi if you have any plans of moving within the first year and selling at home. The reason I wouldn't encourage that is because you wouldn't be able to recoup the closing costs that you're going to have to pay to refi. So that's number one. Another thing you want to do is make sure that you're at least saving close to 1% on your interest rate. For example, your current interest rate right now might be, say, a 6.5%. And if you did a refi, you might be able to get a 5.5% rate. You're going to be saving 1%. That's what you'll be saving, 1%. And at least that's where you want to start. Another reason you may want to refi is you may have an adjustable rate mortgage. Okay? You may have an adjustable rate mortgage right now, and with that adjustable rate mortgage, you may have a rate right now of, say, 5.5%. But that rate may adjust and it may go up. You may have something called an annual cap rate of, say, 2%, which means that the next year, after you add their 2% annual cap rate to this 5.5, next year that rate could go up to 7.5%. So if you could refinance now on a fixed rate mortgage for 5.5% and have it fixed for the remaining of the loan, it might be a good idea and a good time for you to consider refinancing, getting out of an adjustable rate mortgage, also known as an ARM. And I tell people all the time, sometimes when that rate starts to adjust, it feels like it's going to cost you an arm and a leg to keep that house. But you can get out of that adjustable rate mortgage and maybe get into a fixed rate mortgage, and then that way you know what your payments for your principal and interest are going to be for the rest of the term of the loan. Another thing to consider when you're refinancing, and it's not always about the interest rate. It could be about the term as well. You may be able to go from a 30-year mortgage to a 15-year mortgage and reduce the amount of time that you have to pay on your current mortgage, saving you thousands of dollars over the course of the loan. Another thing you might want to do when you're thinking about refinancing a home, it might be a permanent home right now for you, but eventually you plan on buying a second home, and you might plan on turning your current home into an investment property. And if you're thinking about doing that, it's going to be very important to try to refi to get the lowest rate that you can on that property. So once you convert it to an investment property, you have a little bit more margin in the rents that you're receiving from that investment property. So when you're thinking about refinancing your home, I want you to take those things I just talked about into consideration. When you're trying to figure out if it's really worth it or not for you to refinance your house, ask your lender, the person who's doing the loan for you, to send you something called a GFE. So it stands for Good Faith Estimate. A good faith estimate. That good faith estimate will show you all of the closing costs that are going to be associated with you refinancing that home. And then you can look at all those closing costs, and then you can divide how much money you're saving per month into the total closing costs that you have, and see how long it will take you to recoup the closing costs that you're going to pay. For example, I'm just using easy math right now. Let's just say your total closing costs are going to be $2,400 for total closing costs. And that's really a low number, okay? I shouldn't use that amount, but I'm just going to use it. Let's just say your monthly payment that you're saving by refinancing is going to be $100 per month that you're saving by refinancing. How long would it take you to recoup your closing costs if your total closing costs are $2,400 and you're saving $100 per month? Well, what we do is we divide that $100 into 24. We're going to come up with 24 months, or either 2 years, and that's how long it's going to take you to recoup your closing costs. Now, some lenders will allow you to roll all of your closing costs into the balance of the loan so that you won't have to bring any money to closing whatsoever. There are several ways of trying to get that done, and to where you can get a loan done without actually coming out without any money out of your pocket on a refi. But you need to talk with a specific lender. But the main thing you want to ask for is a good faith estimate, a GFE, and it will disclose all the fees associated with refinancing. Then you can divide the amounts that you're saving into that amount that's on your GFE, and you get a good idea of how long it's going to take you to recoup it. So if you're planning on, in this scenario we just used, if it's going to take you 24 months to recoup your closing costs, you can see why I wouldn't recommend you to refinance that home if you know you're going to move in a year or so. It just doesn't make sense.